Well, welcome everyone to your FSA Borrow training sessions. My name is Gary Brester. George Haynes very nicely asked if I could do a little presentation for you regarding crop and livestock marketing, price outlook, and price risk management. I was happy to do so. While you're watching this, I should be in sunny Southern California teaching a class down at Cal Poly San Luis Obispo. But I applaud all of you for working through these marketing training sessions. I'm going to work through 5 different sessions here, sections. We'll talk a little bit about wheat outlook and cattle outlook, thinking about future prices for both those commodities. Talk a little bit about price risk management from using contracts as a potential way to manage price risk, and then we'll follow that up with futures and options. I'll delay just a little bit in between each one in case the session needs to pause for a few minutes. I will start with wheat outlook, and before I move there, let me just note that for both wheat and cattle prices, or the price of anything else, when there's a commodity futures market out there for a product like corn and soybeans, other things, if I really knew what the price of wheat or cattle or corn is going to be next year, nor would anybody else let you know about it. We wouldn't tell you. Why? Well, there's just too much money to be made by owning that information rather than providing it either at very low cost or even at high cost. It just makes no sense for me to give out such great information. But one thing we can do is think about the fundamentals that surround prices, and that gives us some idea, I think, about direction and whether or not we think prices are going to change a lot or a little in the future. So we'll start with wheat outlook and go from there. I always like to think about some correlations that exist between some of these grain commodities. Sometimes we sort of fail to think about these things, but I have here monthly average U.S. prices for feed barley in the pink line, the brown line for corn, and the green line for spring wheat, and this is all U.S. prices. And so we see, of course, there's variability in these prices, which is the question then as to what that we'll try to answer later on. How do we try to manage some of that price risk variability? Let me also say, though, we love, if you're a seller of these commodities, a producer and a seller, we love this upward price movement. Those are things that we'd like to not limit, but it's the downside things that we unfortunately need to work oftentimes at trying to limit on the downside price risk. Now, these prices, I think it's pretty clear, tend to move together. And it's not that surprising that the correlation between corn and barley prices is 0.95. If these two prices were perfectly correlated, then the number would not be 0.95, they'd be 1.0. It would mean that the price would move up in corn and barley would move up as well. But 0.95 is pretty darn close to 1. So these things are very highly correlated, and of course that makes a lot of sense because of their common usage as feed for cattle and in some extent hogs. The interesting correlation to me is the one between corn and spring wheat. Using that data I showed in the previous slide, the correlation between these two is 0.91. Now that's not as highly correlated as the corn and barley number, but by gosh, it's pretty darn close, and it's not 1, but it's certainly not 0 either. So those would be the boundaries for any positive correlation. So this number is a lot closer to 1 than it is to 0, of course. And so you might ask why. Well, first of all, there are certainly some production substitutions opportunities. If the price of wheat is relatively high, more wheat gets planted on some ground that could have been planted to corn, and vice versa. Also, the world uses a lot more corn as food, which is a substitute from the wheat side of things, than what we certainly do in the U.S. And certainly the bigger one is probably worldwide wheat use as a feed. We do feed some wheat in the U.S., but not nearly to the extent that wheat is used as feed in Europe and in Russia and other places like that. The story here is that U.S. corn is always a major player in the world. The U.S. is the world's largest producer of corn, largest trade partner in corn. And in addition to that, the production of corn and corn prices influences both barley and wheat prices quite a bit. If we think about world wheat production, wheat is trade. I'll show you the shares that major countries have in terms of wheat production. And we tend to get a little bit provincial in our thinking frequently about U.S. prices or Montana prices. We think about Montana price and we often think about what kind of year Montana had, but in reality, we have to be thinking about the total world supply of wheat, since so much wheat is traded amongst countries. And the story here is that we had some pretty high prices in 2010 and 2012, primarily because we had some pretty low world wheat crops. But the last 4 to 5 years, we've either hit a new record or, as it is in 2017, very close to the old record in terms of world wheat production. We're up around this 750 million metric tons. And so this pretty much tells you all you need to know about prices for wheat, because if demand only increases fairly slowly along with population, it's a supply side phenomenon that has the most to say about prices. And so we've had very high production in the world for the last 5 years or so, following a couple of years that were not very good at all. In Montana, then, our all wheat price reflects this movement. That is, when world production is high, Montana wheat prices are low, and vice versa. We, of course, had this very high price 2011, 2012, and then prices have declined since. Now, I only have data through 2016. I think because of the rebound in Montana, especially high protein spring wheat prices this summer and into fall, I think our average wheat price ought to tick up a little bit when the 2017 numbers come in. Montana grain production, Montana is a major producer of wheat. I tend to think about it this way. The U.S. produces about, I'll show you the numbers in a minute, 9 or 10% of world wheat production. Montana produces about 8, 9, 10%, depending upon the year, of U.S. production. We have been, when we think about all grains, including barley and other grains like corn, we've been in this 225, 250 million bushel area for the last decade or so, until 2017, in which case, because of drought in many parts of the state, we ended up with just something over 150, maybe 160 million bushels of total grain. We tend, in terms of wheat, durum tends to be fairly steady. Barley has been fairly steady, and we tend to split our wheat crop at the end of the day. We tend to have about half of our wheat crop being spring wheat, half being winter wheat. Of course, a lot of that depends upon yields, but we're sort of 50-50 on those two. If we think about wheat market fundamentals then, in 2017, U.S. production numbers, when they finally come in, will probably be somewhere around 1.75 billion bushels. That's down some from last year, so a lot of other parts of the country had some lower yields as well. And also the acreage planted in 2017 was down by about 5 million acres from the preceding year. So a little lower acreage and a little lower yield means lower production. The ending stocks will be lower in the U.S. than they were a year ago, about 300 million metric tons lower. A beer somewhere around 900, and again, it's because of the lower production within the U.S. Now, here's the numbers I said I would get back to in just a minute. Again, it's certainly important to think about U.S. and Montana within the world production of wheat, but in reality, the U.S. is sort of an average-sized player in these markets. The EU 27 in 2017, out of the 745 million metric tons of wheat produced, here, the red line shows that about 20% of that was produced by the EU 27. The blue bar is showing the similar amount produced in 2016. China produces about 17% of the world's crop. All other countries have combined are another fifth or a little more than a fifth of world wheat production, 22%. India is a major player we often forget about, I think. Last year, 2017, this year, I guess, they produced about 13% of the world crop. The U.S., I said production was down. We produced about 6% of the world crop, but typically we're a little higher than that. You notice the blue bar was probably closer to 8 or 9% back in 2016. Russia, very similar to the U.S. They had a pretty good year this past year, 11%. We're in the same area. And then places like Ukraine, Canada, Australia are all in that 4%, 3 to 4% of world production ranges. If we think about wheat market fundamentals, then we've had 5 years in a row of world record production, or very close to it this past year. It wasn't quite a record, but very, very close. Ending world stocks are at record levels, 263 million metric tons. Consequently, we can expect lower prices as a result of all of that. The September 18 spring wheat futures contract, when I did these slides, don't know what it is now, but when I did these slides, was trading at 634, and that already accounted for the fact that we had a pretty large corn crop in 2017, and that the wheat crop was a little bit down, but still certainly not disastrous for the U.S., and that we have quite a bit of carryover stock. So futures markets combine that information on a very timely basis, almost minute to minute as new information arrives. So it becomes a pretty good forecaster, at least from right now. It becomes a pretty good forecaster of what we can expect the price to be. This is Minneapolis Grain Exchange Futures, 634 for 13.5% protein. Spring wheat, dark northern spring wheat. Now, if someone would help me out here in the crowd and tell me what kind of weather we can expect, let's say in the U.S., Montana, the world, everywhere, whether we'll see droughts or floods. One year in Montana we saw both. Tell me a little bit about acreages and yields and how much protein there'll be. Then forecasting the future would be pretty easy. But we don't know these things. So here's the best you can do. And by the way, the research that was done by agricultural economists over decades has shown that the following 0.5 here I'm going to use as your best guess of next year's spring wheat crop is the best procedure you can use day in and day out. Once in a while, a Ouija board might work better. Once in a while, staring at crystals or crystal balls or whatever might all work. But the reality of it is that you can't do any better day in and day out by using the following process. So, what do I mean? Well, let's say that you sell grain in Great Falls. Now, if you're selling somewhere else, the story's the same process, but a different set of numbers. In September of each year, the 13.5% spring wheat basis averages 10 cents below Minneapolis Grain Exchange. Meaning what? Well, if you look out and see 634, like I did when I put these slides together, September spring wheat futures, and historically at Great Falls, in September, we tend to be a dime underneath whatever the grain exchange is trading at that exact same time. Now, that means that if my best guess of the difference between a national price and the Great Falls price is 10 cents, then my best guess is to expect, my expectation then for cash prices at harvest time for spring wheat in Great Falls is 10 cents below the 634 or 624 a bushel. Now, could the basis be stronger? Well, of course it could. It happened this past year. This past year, we weren't a dime in September under the Minneapolis Grain Exchange. Depending upon protein levels, we might have been as much of $1 a bushel above it. That would mean the basis didn't go back to the average level it usually had. It actually flip-flopped, and we actually had a higher price in Great Falls than they did at Minneapolis Grain. Why? Well, we needed high protein. The local market said, bring me your high-protein spring wheat. I'll pay you more for it. And the basis then becomes the result of what? The result of traders at Minneapolis making exchanges, well, around the country, but at the Minneapolis Grain Exchange, making their best guesses, and your local elevator who is basing their prices on what someone's willing to pay them. When all that's said and done, whatever the difference is between those two prices, that becomes your basis. So it's not a thing, it's a result of all of that activity. So that would be my best guess for wheat market at this time when I put these slides together, 624. Will those prices change? Of course they'll change. We get new information all the time. Weather, demand, supply, all sorts of things happening. But that's your best guess at any point in time, and this is the best process for doing that. Now, one of the things you can do is also use a little tool that was put together primarily by Anton Beckerman in the Department of Agricultural Economics and Economics at Montana State University. Free website called wheatbasis.montana.edu. And what this allows you to do is let a computer program do the hard work for you in terms of thinking about what basis might be and how it might change over time. When you go to the website, you see this picture, and then you can use this website for forecasting the basis, because we might have some information as the year goes along as to whether or not we'll be near that 10 cents difference or above it or below it. And there's other information here about what we mean by basis and some technical details about how this program works. Now, this program allows us to do some basis forecasting, and from that then we can make a forecast of the market down the road. Here's an example where I use this for Montana. There's other states you could use, but obviously we're in Montana. The closest location I assumed for a producer might be a Conrad. You can use this program for hard red spring wheat or for hard red winter wheat. If it's hard red winter wheat, then you're looking at a July forecast. If it's hard red spring wheat, we're making an early September forecast. You put in the protein amount that you think, the number of bushels that you think you might have, and you hit run model. When you do that, the results are showing us that the futures price, and this matches pretty closely to when I put these slides together, was 641 on the day I ran this program at Minneapolis, and our best forecast at that time was for a basis of -8 cents for an expected cash price of 633. Very similar to kind of what the average expectation would be, maybe 10 cents below that futures price. So this is a pretty nice little program that you can use on a daily basis if you want to think about what our models are forecasting the basis to be. Now, I'll take a quick second just for a break in case the program here needs one. Okay, we'll return now and think a little bit about cattle prices. And again, I'm thinking about feeder cattle prices. And again, I'm thinking about this from the standpoint of someone who is trying to sell calves. So the fundamental, I always like to start with some of the bigger market fundamentals. In this case, let's think about what's happened to world beef production over the last several decades. And from this graph, you can see that we have gone from about 43 million metric tons back in 1980 up over 60 million metric tons here the last couple of years. So certainly an upward trend in beef production. I think a big question becomes, do we expect production to continue on the green line, if that's the linear trend that you get out of that data? If it is, then you'd start forecasting future world production off of that line so that you just keep extending it out, and you'd expect similar increases down the road. On the other hand, and I'm going to try to convince you that I think the green line is probably not the trend line that is going to occur in the future. I'm trying to explain some of the reasons for that. If we have really a new trend line that looks like this pinkish fuchsia color line there, it might be a lot flatter. And I think there's a number of reasons why world beef production is going to be flattening a little bit over the next decade or so. Here's a picture of world cattle inventories. At one point in late 1980s, early 1990s, we had about 1.1 billion head of cattle. January 1 inventories around the world. There was a couple years there clearly of a big drop off, but that was just a couple countries not reporting their numbers clearly. And today we're down. We were down to about 980 million head. Now we're back up to right at a billion head of cattle around the world. Now, one of the interesting things I like to show while I was looking at data one day was sort of uncovering this set of data. Last year, this would be for 2016 because I obviously don't have the 2017 numbers yet, but I've got two sets of numbers here. On the left side, I've got millions of head of cattle, January 1 inventory, and this is by the countries you see across the bottom. And up the right-hand side, I have millions of metric tons of beef produced in each country each year. Now, some of this can be a little bit skewed by trade, but nonetheless, this is pretty close to reasonable numbers for showing the following. Let's start with the United States at the far right. We had about 92-3 million head of cattle at the start of January 1 of 2016, and from that set of animals, and we had about the same amount of imports as exports, not quite, but pretty close. Out of all that, we produced almost 11.5 million metric tons of beef. So the blue line, the shaded blue line in there, kind of cross-hatched area, that shows how much beef was produced in each country. The wider red bar shows how many cattle existed and produced, for the most part, that beef. If you look at the EU28, I'll move my pointer here, we had pretty similar cattle numbers. See the size, the height of the bars are about the same. But notice the production from the EU28 is much lower than the US. It's maybe 8 million metric tons. So what does that say? It says the United States is much more productive in producing beef from the herd size that we have relative to the EU28. China has a few more cattle than the United States and the EU20, not much. I'll show you the numbers in a second, but they produced about 7 million metric tons, even though they had about the same number of animals. India, of course, India has cattle for dual purposes, for draft animals and for dairy. They don't eat a lot of beef in India for religious purposes, but they do produce some beef that's lower quality, and that's sent to other, mostly Middle Eastern countries. Nonetheless, they had over 300 million head of cattle in India, and they produced about 4 million metric tons of beef from that. Brazil does produce beef for beef consumption, human consumption, and they had about 220 million head of cattle at the start of 2016, and that's more than twice the U.S. It's about 2.4 times what the U.S. had, and yet they could only produce a little under 10 million metric tons. Twice the cattle, more than twice the cattle, and they can't produce the amount of beef that the U.S. can produce. Now, you might say, well, and so Canada's a pretty small producer. They're a little more productive than what this would show, simply because they trade so much beef, export so much to the U.S. Mexico is sort of so-so, not really great. Australia's okay. Argentina's not very productive. Russia's not very productive at all. And a lot of this, of course, has to do with the fact that the United States grain feeds cattle, so we get more beef. We also have, in many cases, better genetics, and all of that is not by accident. We have unfair advantages in the U.S. We often hear about the advantages that other countries have in lower labor, and in many cases, unfortunately, lower environmental concerns and those kinds of things. Nonetheless, the United States has tremendous advantages in what way? Infrastructure, contract law, law and order. Hard to be productive in anything when you have a civil war going on. We have, I'm not going to say no government corruption. I don't think that's possible, but we have very little government corruption. As a result of, and we have risk management institutions. We have insurances. We have futures markets. We have lending systems that work. The United States, right now, we borrow money. I don't know, folks, what are you borrowing money at? 5 or 6%, something like that. In the Ukraine, it's 28%. Why? Well, the Ukrainians would tell you it's because the banks are big, mean, bad people. The reality of it is there's so much risk for someone lending money because of the inability to collect collateral, because you never know when other countries might decide that part of that country belongs to them, those kinds of uncertainties. So India, if you take a look at some of the 3 largest cattle herds, it's in India, the brown line, and they've actually increased cattle numbers, not production numbers, over the last decade or so, but not a great deal. China's actually reduced some of their cattle numbers, and in fact, it's one of the reasons why China is actually starting to consider perhaps better trade relation with the United States regarding beef. They're expected to continue to lose cattle numbers and use land for other purposes. The big increase in cattle numbers across the world really is in Brazil. But again, Brazil is not very productive at producing beef. They have a lot of things that hamper that, including corruption in government, including contract law that's not very stable, court systems not very stable, and the fact that they're near the equator and animals in that sort of heat and humidity and insects and parasites and all that sort of stuff. Kind of a tough place to raise cattle. The more productive countries, Argentina is not all that productive, but I threw them in here anyway because they're kind of a middle, one of the larger beef cattle producers in terms of numbers. But you see the U.S., our inventories have generally declined over the last couple of decades, a little bit of an uptick this past 2 years. The EU28, their cattle numbers have declined, a little bit of an uptick the last year, but not much. They're not going to put more cattle out in the EU. Argentina is just not a player. They got cattle. They don't have markets that work. Australia is pretty flat in terms of cattle numbers, as is Canada. So if we think now more about the U.S., I've got two lines here. The brown line shows January 1 U.S. cattle inventory each year. Last year, at the start of 2017, we had about 93.5 million head of cattle and calves on the ground at the start of the year. And that was up about 1.5 million over 2016, primarily in response to higher prices. That's what happens. When prices go up, people try to produce more of that commodity. In this case, we had an increase in cattle herd sizes. But the 2016 calf crop still was relatively low compared to years ago. In fact, we're down about the same numbers in 1950. But that doesn't mean that we produce a lot less beef. If you take a look at the green line, and I have it in quotations on the legend, U.S. beef production, this is the production of beef from that cattle herd inventory in the U.S. I've already taken out imports, exports, all that sort of stuff. All I got here is from the cattle that are in the U.S., here is what the amount of beef that's been produced by that herd. And back here in the 1970s, it took 130 million head of cattle to produce about 25 billion pounds. And as you go over the last several decades, last year we produced about, 24 billion pounds with a heck of a lot fewer animals, 93.5 million head. That started that year is actually 92 million head. So the reality of it is we've become much more productive, and these two lines continue to diverge. I am a little surprised. It's a big uptake in 2016. See that green line jumping up there a little bit from 2015. I'm really surprised we're able to produce that much more beef, but 15 pounds of carcass weight added over the previous year on the slaughter of 25 million steers and heifers can cause that to happen. I was a little surprised it was that large. This line then shows the productivity that I've been talking about of the U.S. beef cow breeding herd. Back in the 1970s, if you took all of the breeding cows and you looked at how much meat was produced in that year and you divide it, you got about 500 carcass weight pounds per beef cow annually. And now we're at this 700, and as I mentioned, 2016, the last data point I have, all the way up to 750 carcass weight pounds per beef animal. What's the source of that increased productivity? Well, heck, it's better education, it's better nutrition, it's better management, it's better marketing, it's fewer open cows, it's better genetics, it's better herd health, it's better nutrition. All of those things combined to improve productivity in this business. And we have larger cows too. If we take a look at what prices have done over time, I've got two lines here. The brownish looking line is the price of fed cattle. This would be 11 to 13 weight Nebraska cattle, choice steers. So that's their annual average of Nebraska cattle, 11 to 13 weight. And then I put the Montana average price per year of 5 to 6 weight steer calves. And so you see that these two move together, which makes perfect sense. When people want more beef or there's not enough around, beef prices rise, fed cattle prices rise, feeder cattle prices rise, as do cow prices, and then of course the opposite is true when things move in the other direction. These are the prices in what economists call nominal terms. What does that mean? It means back here in 1970, if you took a feeder calf, a 5 to 6 weight Montana steer calf, to the auction yard, on average, right back in here, on average, you got, I don't know, $35 a hundredweight for that animal, on average throughout the year. Okay, and last year in 2016, when you took that calf in, at least whether it went to auction or not, the average amount that one got for that was $170 a hundredweight. Okay. 2 years ago, we were on average around $250 a hundredweight. Some lighter calves, some higher quality calves actually were sneaking up at that $300 a hundredweight figure. But this is the average for the whole year. Now, as you might be guessing, yeah, $35 back in 1970, but heck, $35 back then would buy you a lot more than $35 would today. And that's absolutely correct. Some of this increase certainly could be caused by inflation. So in order to think about that, I've taken that data and I've put it into what economists call real terms. What that means is I've put all of the numbers into 2016 dollars. Let me explain it this way. Back here in 1970, that $35 per hundredweight that you got for on average, the 5 to 6 weight steer calf in Montana would have been, in today's dollars, about $160. And that's about what they were in 2016. So in real terms, that $35 was very similar to the price that we got in 2016. And you can see these prices have certainly varied over time. Now, a couple of things to figure in here, and then I'm going to come back to an outlook. You can't talk about beef prices without thinking about the poultry and pork markets. And in fact, that 2015 and 2016 period, we had high calf prices. One of the reasons is that pork and poultry production ran into some problems. PEDS in pork, avian flu in birds caused some disruptions for at least a while. We weren't certain how long it would last. It's quite remarkable how short that problem was. You take a look at poultry production. Back in 1980, the U.S. produced 12 billion pounds of poultry, and last year we produced 46 billion pounds of poultry. Pork production was about the same level back in the early 1980s as poultry, and today it's 25 billion pounds, very similar to the amount of beef that we produce as well. But poultry production is almost double what either beef or pork production is. So this means there's more animal source protein on the market, and both those products certainly compete with that beef consumer dollar. Imports and exports are always of interest to beef producers, and they should be. I've shown here we import I'll start with imports. We import a variety of things. We import live calves from Mexico, primarily into southern feedlots, primarily so that we can have a fresh beef supply year-round, because if we had to depend upon northern cattle, which are primarily calved in the spring, weaned in the fall, you're just not going to have a continuous supply of beef, and northern cattle don't live very well down south. So these lighter calves come in and they're fed out in many of the southern feedlots. From Canada, we import some fed cattle that are already heading to a slaughter plant. We import some beef, carcasses and trimmings from Canada as well. So consequently, I've taken those numbers and put them all onto a pounds basis. I took a head of cattle that come in, convert them to a carcass weight basis, and added them all together so we have a common denominator. And then we import beef, mostly trimmings from Oceania and a few other countries, so that the total of all this in the last I don't know, decade or so, a little longer than that, maybe since the turn of the millennium, we import on average somewhere around 4 billion pounds total. Now, some of you might say, wait a minute, why do we import beef? Can't we feed ourselves? And the answer is we are a country that can feed ourselves. The question is, what are we going to feed ourselves? You have to know that many times when we have cattle coming out of grain fattened, grain finished feedlots, and they're pushing that 14, 15, occasionally 1,600 pounds, we got a lot of fat on those animals. Of course, we push them to get that high choice, that prime, the tenderloins that I love to eat. And so in the process of doing that, half of that animal's meat, meat from that animal, as all of you ranchers know, is going to be hamburger. The problem is, as much of that hamburger is only 50% lean, which means you basically can't eat it. It has to be leaned down. So we lean it down with our cull cows and our bulls. We raise a few grass-fattened animals, not very much. If it's grass-fattened, it's probably not being put in to that commodity beef system anyway. And so we have to figure out a way to sell a product that really isn't palatable to most people. One way to do that is to bring in grass trimmings from cull cows, for example, out of Canada, and especially from Australia and New Zealand, where there's very little grain finish animals, so much leaner animals, and we bring in that meat and we lean down our hamburger to make much of it palatable that would not be palatable. If we think about beef imports by source, now I'm not putting in live cattle here. I'm taking them out. Okay, so just because the live cattle are going to come from either Mexico and calf or fed cattle out of Canada. If you get rid of that, then we have about 3 billion pounds of beef. Okay, another billion pounds from all that other sources. And so where does that come from? Well, I have an area graph here that shows you the darkest color on the bottom shows that last year we had about 3/4 billion pounds. Of that 3 billion, about 3/4 billion came from, so about, what is that, not quite a third, 25% of it came from Australia. Another 15% or so came from New Zealand. A full billion pounds came as meat from Canada or from Mexico. And then a little bit from Uruguay or Brazil or wherever else people import beef from is a very small amount, that dark blue part up there, maybe a 1/4 billion pounds at the most. And these shares have been relatively stable. You notice in 2011 the imports were very low, okay? And you'll also notice in 2011 exports were down a little bit. The big difference, of course, in exports occurred in 2004 after the 2003 BSE incident. So let's look at beef and live animal exports. So I again put all these in billions of pounds. We don't export a lot of live animals, so most of this is beef, or it's inedible offal, or it's offal that people eat, such as kidneys and tongues and hearts, but not much in this country. So there's a whole lot of product that goes out. We also sell an awful lot of what I call middle meats into Mexico. Canada is our biggest export destination. It flip-flops a little bit between there and Japan, but Canada is one of the major export destinations, and they're taking the traditional high-quality beef. A lot of the meat that enters from Canada enters from the western provinces down into our Utah, Washington State, even Nebraska packing plants, and much of the beef that moves into Canada moves into their population centers on their east coast. So we actually have a product moving north to south in the western part of North America, Canada and the U.S., and moving from south to north on the eastern part of those two countries. Since we've had the Canadian-U.S. Free Trade Agreement in 1988, and then again the NAFTA Agreement in 1994, we've seen an increase in our exports up to about 2.5 billion pounds. Big drop off because of the BSE concerns, and then back up here to about 2.5 billion pounds. So we export a lot of high-quality beef as well to Japan, to Taiwan, many other Asian countries, as well as Canada. And as a result, we export different products than we import. We're exporting about 2.5 billion pounds. We're importing about 4 billion pounds. But when you think about the value of what's exported and imported, the U.S., except for the 2 years following the BSE finding, the U.S. has generally been on the positive side of that trade equation. That is, the railroad track looking marks I have across the crosshatch area, that's zero. And anytime the pink line is above that, it means the value of our exports, including hides and inedible offal and lard and all those kinds of things, beef fat, all those kinds of things that go out of the country, the value of that is more than what comes into the U.S. Now, the other thing I want to point out here, folks, is I tend to talk about this, and everybody does mostly, that the U.S. does this. The U.S. trades more beef one way direction. The value, folks, the U.S. does nothing of this. The government's not involved in beef trade to any major amount at all. What is involved is hundreds of companies making decisions. How do I lean down this beef? Where do I get product from? Where do I sell product to? Who wants 5 or 6 or 25 containers of beef tongues this month? Where do I send them? And these data are the result of hundreds of firms and millions of decisions that are made. We tend to say the U.S. does this or the U.S. does that. In my opinion, fortunately, it's the result of firms making these kinds of decisions, not a single entity called the U.S. So let me just finish up here a little bit on this outlook. Domestic demand for beef has been a little stronger over the past couple of years. Yes, per capita consumption is lower, but we had lower beef to go around. We didn't have as much beef produced until last year. As a result, if you have less to go around, per capita consumption has to decline. That isn't a decline in demand. It's allowing prices to allocate. And so we've still been able to keep a fairly high price even though per capita consumption has been lower. That doesn't mean that demand can never fall. If demand falls, it means that people are consuming less beef even at the same or a lower price. And that's not a good thing. And in fact, we saw a fair bit of demand decline throughout the 1980s and into the 1990s. This bar graph just shows you an index of beef demand calculated in an appropriate way. And there's nothing special about picking 1980. I just did it. I call that amount of beef demand 100. And numbers below 100 are declines in that beef demand. These are very real concerns the industry has. And as demand declined, partly because poultry production was increasing, people substitute poultry for beef. So if I'm consuming less beef because of that, that's a decline in demand. And we saw demand decline down to about 71, 72% of what it was in 1980. But we saw some recovery at the turn of the century, this century, and we saw some increase. We saw some decrease in the early part of this decade, primarily because of the recession. And I think we're seeing a little bit of recovery since then as incomes start to rebound. Foreign demand for our U.S. product has been increasing because of increasing incomes in places like China in particular, increasing populations, people have to be fed, and these are relatively slow changes. I mean, I think it's great that it's positive, it's growing. If we have fewer trade restrictions on getting into certainly China, certainly the tariffs that have been put on beef by Japan are trade embargoes. We are at a competitive disadvantage simply because of a policy that says if the product comes from the U.S., we're going to tax it 35 or 36%. As these trade restrictions, if they can be lowered, then we would see a lot bigger increase in foreign demand for U.S. beef. We have seen cattle numbers decline not only in the U.S., but we've seen them decline in many of the major beef producing countries. Other than India and Brazil, basically we've seen declines everywhere. Why is that? Well, this is some of the research I've been doing over the last 10 years or so. I think it's pretty clear that the costs of producing beef have increased in real terms, in inflation-adjusted terms. Partly this is a story about grass. We've had major drought in some region of cow-calf country, somewhere in the United States, virtually every year for the last 15 years, whether it's Eastern Oregon, whether it's Montana 20 years ago, Montana now, Colorado, Florida, huge cow-calf producer. And certainly the desert Southwest, the Arizonas, the last few years. So we've had trouble getting enough grass. We've had feed costs rise primarily because of the renewable fuel standard that caused a lot of people to raise more corn. That meant less corn for ethanol, less corn for cattle, less corn. More corn acreage meant lower alfalfa hay acreage, lower grazing acreages. Grazing availability has certainly not increased in a couple of different areas. Certainly wilderness areas. We've expanded national parks. We've reduced AUM usage on BLM and Forest Service lands. We've had some drought problems in those areas as well. I'm not saying this is something that's wrong. If people would rather have a wilderness area than cows tramping around on that land, that's a decision society makes. What I am saying is the result is there's less grass to go around. That's all. And so as a result, the grass that's left is more expensive. And certainly labor costs continue to rise. That's a real problem for you producers out there. I understand that. On the other hand, that's a sign of an economy where standards of living is continuing to rise. There's really cheap labor in many parts of the world, for example, North Korea. Nobody wants to live there. And then, rather than raising cattle, there's been a lot more profitable alternative production possibilities. Certainly crop profitability has increased over the last several years. Crop insurance has reduced the risk of producing crops more so than of producing cattle. The average age of agricultural producers continues to rise. The Census of Agriculture clearly shows this. As a result, as people get older, as they have fewer kids around, the cattle go first before the combine goes. And if you look in eastern Montana, folks, you all know what I'm talking about. And I know I'm old when I start saying back in the day, but back in the day, there were very few wheat farms out there that didn't have some cattle stomping around, grazing some of that stubble, taking care of the coolies. And boy, you don't see as much of that anymore. So I think that's partly why we've seen less animals around. By the way, that's also true in other countries as well. And then I think we've seen some structural changes. I think we now have a production system where we have many more full-time relative to part-time producers of cattle. As I just mentioned, many of those wheat farmers don't have cattle out there. So who you have left are those producers who say, look, I am set up for 850 cows. I am set up for 430 cows. I am set up for 1,200 cows. Whatever it is, but they're full-time producers that are not going to be expanding much and probably are not going to be contracting nearly as much as those part-time producers who are in and out of these markets. Same thing has happened in the hog industry, by the way, and certainly the poultry industry. So for all of those reasons and the fact that we now have larger cows, which also mean you have to have more grass per cow because they're going to consume more, I think we've seen supply. And this is the story I started with. I think this is a similar story around the world for all sorts of different reasons sometimes, but that's why I think we're going to see more of a flattening of world production of beef rather than the continued linear trend upward. So one of the things I like to do, and I'll finish up here just a couple of slides that thinks about calf prices. This is a story here, here's the background. What would I forecast for calf prices coming up? Well, I'll show you in just a minute for next year, but if you look at a long-term trend, this is inflation-adjusted calf prices into 2016 dollars. So today's dollars. Okay, back in 1910, that's as far as the date I can find back there, a calf in today's dollars sold, a light calf, for in the U.S. for about $125 a hundredweight back in 1910. And last year in the U.S., that calf was selling for about $170. So you see a lot of variability here, no question about that. But if you look at that dotted purple line, that's a statistically fitted trend line. And notice that it has been that it is sloping upward. And so my long-term forecast for calf prices is relatively bullish. I think you're going to see variability. You always do. That's the nature of the beast. But I do think that there's a number of reasons why you return to those trend lines eventually, and I think we'll see calf prices in that $1.60, $1.70 range down the road. They'll be higher sometimes, they'll be lower, but that's where that trend is heading. And the reason is that the real costs of producing cattle continue to rise, and eventually in a commodity market, these prices reflect those increasing costs. So 2018 cattle prices, here's the outlook then for next year. U.S. beef production is forecast to be a little higher. Remember, we have a few more animals out there than we did a year ago, but also about the same increase is expected for pork and poultry production. World inventories and production are really pretty flat right now. I mean, I don't see much that's going to say you're going to see big increases in production somewhere. I think domestic demand is likely to be solid. I don't see any real reason why we would think demand would decline a lot for beef. And so using the strategy that I showed you before, the farthest I could get out on Chicago feeder cattle futures is August 18th, and they're trading pretty thinly. Okay, there's not a lot of action out there yet. But if you look at that market, a couple of days when I did these slides, feeder cattle were trading at $1.44. Now that's for a heavier animal that's traded on the exchange. So for lighter calves in Montana and the transportation sorts of things, we tend to be on average about a +5 over top of the $1.44. So $5 onto a $1.44 a pound, you have $1.49 a pound for 5 to 6 weight calves. That's very close to that trend line that I showed you earlier. And for a little heavier calf, it suggests about $1.40 for next August. I know that's not when we're selling a lot of animals. That's the furthest out I can get because we tend to be about a -4, $1.44 minus the 4. Another sort of website to help you with forecasting and to keep track of these sorts of things is a website that's free called beefbasis.com. And in fact, the wheat model I showed you earlier was modeled after this work that was done by some folks in Wyoming. So if you go out to beefbasis.com, you can forecast a feeder cattle basis, which then allows you, based upon futures contract, it allows you to make a forecast of your calf prices. So it allows you to pick a state, location. Most of the location where there's data is actually public auction yards and billings. You pick steers or heifers, grades, weight, and then all you do is go over here to the right and pick your expected sale date. Now again, the furthest out I could get is August 23rd, but eventually you'll get into October, etc. And you pick those things, hit run. And what this is telling us, I've got my pointer on $1.48. The beefbasis.com website on the day I did this forecasted a feeder cattle basis to be $2.90 over top of the Chicago price, and consequently for that weight animal, the forecast is for $1.48. Very nice little program. You can run it. It changes all the time because the feeder cattle futures prices settle and the corn futures prices settle at different levels every day. So with that, I'm going to take just a minute, 30 seconds here for a quick breather, and we'll move on to price risk management topics. Okay, let me start here by thinking about price risk management. Now, one of the things, and in this sense, I'm going to talk about 3 different ideas. One of them is called contracting, which you're very often familiar with. Another is futures markets. Another is using options markets. But in every case, what we're trying to do with these kinds of tools is manage price risk. I almost always get asked to come and talk about futures and options and contracting when prices are low, because people say, I want to learn how to get a higher price. That's not the time to think about it, okay? The idea of price risk management is to prevent lower prices. So if prices are already low, you know what? It probably doesn't really pay. Now, if you're going to go in and use any kind of price risk management, you very often are going to be limiting. The idea is to limit downside price risk, but it often means you're going to cut off or limit the upside price potential as well. And that's something that people have to be able to live with. By the way, that doesn't mean that every bushel or every animal has to be forward contracted or has to have a price floor set under it. But for many people, thinking about being able to meet your operating notes, your mortgage, that sort of thing. One of the things to be thinking about is how much downside price risk can I accept and still be able to meet those kinds of obligations. So let's talk about contracting first. As I mentioned, if you know that prices are going to rise between right now and either harvest of grain or the delivery of calves, goodness gracious, don't do anything. In fact, you need to call me, and we'll go to my broker, and we'll speculate in the futures markets, and we'll just make a ton of money if you can convince me that we know prices are going to rise. Actually, if you know prices are going to fall, we could still make a ton of money. So either way, so any of you out there, give me a holler when you're absolutely certain you know what's going to happen down the road. Actually, my phone won't ring very often. Price risk management then is a process of reducing downside price risk, and often, but not always, it means you're going to forego upside price gains. Now, as you might expect, just like when you buy insurance of any kind, if you're going to limit your downside losses, that's what auto insurance does, that's what fire insurance does, that's what crop insurance does. You lower the downside loss. You're going to pay someone to accept that risk. That's what you do when you buy insurance. You pay someone to accept the risk. Why would someone accept the risk? Well, with higher risk comes higher returns. Consequently, if one has deep enough pockets, providing that insurance is often a profitable endeavor, but not always. Just take a look at the hurricane losses that are going to occur this year for homeowners insurance providers in Florida. A little terminology. We've talked about it before, so I can go pretty quickly. Basis is simply the difference between a specific futures contract price and your local cash price at some point in time down the road. So the basis is the outcome of whatever you can negotiate for the cash price locally versus what the national price is, and we're going to use the futures price as an estimate of the national price. Certainly the basis can vary. The difference in Great Falls and Minneapolis for grain varies. The difference can be high or low. This past year, it was actually a very low difference in the sense that Great Falls prices were above Minneapolis prices. Most of the time, Great Falls grain prices are below. But the variability of those prices of the basis is much less than the variability of national prices, because the basis primarily is the difference in transportation and local conditions that might cause local prices to change or differ from the national price. Here's a little picture I think that helps explain this. This is on the left hard red spring wheat and on the right hard red winter wheat. This is Great Falls 13.5 protein spring wheat, and this is 11% hard red winter wheat. And the national average price cash range for hard red spring wheat, 2010 to 2014 years, so 5 years of data, the difference between the high and the low cash prices for spring wheat in September was almost $4 over this 5 years. That is, prices were, so we all know about that variability. The interesting part is the basis range at Great Falls, the high and low basis was only $1.50. So a lot of what we do when we either forward contract or use futures and options is we trade off some of the variability that occurs in cash prices for variability that occurs in basis prices, basis ranges. And the basis variability is usually quite a bit less, but it's not zero either. So we've already talked about thinking about an expected cash price, the difference between a futures contract price and the expected basis that's going to occur at the time of harvest or delivery. In September, if the 14% spring wheat basis has averaged about 10 cents a bushel under the futures, which it has over the past several years in Great Falls, then, as I showed you earlier, if you have $5.65 wheat in Minneapolis for next September, the best guess you have of your expected cash price is $5.55 as of today. So, in a forward contract, what you're doing is finding someone who says, I will offer you a fixed, usually a fixed price, okay, that was going to minimize your downside price risk and perhaps even remove all of your basis risk depending upon the contract. What are some of the issues? Well, first of all, you have to find somebody willing to do it. Okay? You have to understand how the contract's going to be settled if you don't have the commodity to deliver. That is, if you have a hailstorm and you can't deliver the spring wheat, what happens with the contract? Many of these contracts say, hey, go out and find the spring wheat and bring it to me. Of course, that could be very expensive if there was a lot of hail in a region. Okay, but there's other sorts of ways. Sometimes in those contracts, it's a cash settlement. They say, you know what? I understand you don't have the wheat. Give me $1 a bushel and walk away from the contract. So that's another option. Some contracts, especially malting barley contracts, will have act of God clauses in them. In other words, they'll say, you're going to bring, my brother raises malting barley for InBev, well, for Breeze and for Coors, and those contracts have acts of God clause in them. If a hailstorm keeps him from getting enough production put together to sell to Coors, there's an act of God clause that says, all right, forget about it. Now, why would they do that? Well, because many producers would never forward contract if you didn't have an act of God clause, because Coors only buys Coors varieties. So you can't just go buy a variety and replace the production you didn't have. How are we going to settle this on delivery? What are the quality restrictions, especially in malting barley, but the same is true for spring wheat too. So making sure you understand that contract is settled. Contracts generally prohibit the participation in higher prices. Sign a contract for $9 malt barley. 1 year, the cash price for malt barley, the non-contract cash price went to $10. You don't get the 10, you get the 9. So that's part of the deal when you do this. Contract prices are generally going to be lower than your expected cash price. I had a rancher tell me this once. He said, you know, I looked at my expected cash price for feeder cattle, and I had a person that wanted to forward contract calves, but they won't do it at that price, at my expected cash price. They want to do it lower. And I said, what a great example. Exactly right. Why? Because they are taking the risk from you when they give you that forward contract. You are, in essence, paying them to take that downside price risk from you. So a lot of times with grains, wheat in particular, you tend to see these forward contracts maybe 10 cents, 15 cents, maybe as much as 30 cents a bushel less than what your expected cash price would be from wheatbasis.edu.montana.edu because of that very reason. And the other thing I want to mention here is that forward contracts are only as good as the person or company that you're forward contracting with. You may have a really strong forward contract with somebody, but if they're not around when it comes time to deliver, that's a problem. So with that, I'm going to stop and give another break here for just a few seconds in case the group needs that stoppage.